So what's happening with this market? We're getting a lot of big up moves and big down moves too. Lots of volatility. So let's do our standard market review and figure out where the market is going from here. And of course, I got to promote before we start the video. So the explosive stocks checklist, it'll teach you how to find better stocks. Get it. It's free. There's a link down below in the description and comments. And now let's jump into the market review. So as always, I got Macro Ops helping me, Alex, with his market brief. So we just got done with January. So we got a new monthly candle print, which is what you can see right here. And the thing about looking at price charts is the wider you zoom out, the larger time frame that you look at, the more accurate the price chart is going to be. And by accurate, I mean the better signal you're going to get. So if you're looking at like a 2-minute price chart, you're going to get a lot of false signals. You'll see a lot more breakouts that fail or whatever else you're looking for, because the shorter time frame that you're on, the more noise you're going to see. So that's why one of the things we look at to determine market direction is monthly candles. So you're looking at the market on a monthly basis. And when you see something on that wide of a level, like if there's a breakout or a trend, then you know you could trust that more. Of course, it's not always going to be 100% correct, but it's a much better signal than using even weekly or daily and of course minute candles. So getting back to this, we're looking at the monthly candles on the S&P. So after 4 straight bull bars, which are these right here, 1, 2, 3, 4, we finally got a bearish bar, a doji sell candle. Now the reason why this is bearish is because the market ran up but then reversed. And when it reversed, it actually closed below where it originally opened. So you got this long wick right here and this short little body. And that's not a good sign. That means sellers came in and took prices lower. They were cashing out as opposed to more buyers coming in and you getting a more full candle like this one right here. That opened and then by the time it closed, it was much higher. Now, if you look at this total chart, the trend is clearly intact, right? This is a bull market. When you zoom out, you could really see it. But based off this doji candle right here on the monthly, we can expect the next 2 months to maybe go sideways or even retrace. So Alex marked a major support right here at 3,000. So if in the next 2 months we get 2 more print candles and it hits this level, that would be a correction of 10% just about, which again would not mean the bull market is over. You're not getting a market crash. It's just a normal correction. And in a normal correction like that, you actually get an opportunity to buy the dip, which the strategy for that, I need to make another video. So subscribe for that. Now, if we zoom in and look at the market on a weekly basis, it shows that the SPX was breaking down below its 4-month type bull channel. And normally when this happens, you get a 2-legged pullback, which is what we were talking about in the last video, where we'll see moves up but then lower lows as the thing comes back down, which is kind of what we're seeing right here with this price action, right? It falls, has a big rebound, and then falls lower. So we're expecting this to happen again, and right now we're on the upswing, but maybe by the end of this week it'll start going down lower again and make a new low. So Alex says right here, if you can see this blue line, this is Fibonacci line in between the 2 greens, that's at 3,100, which should act as major support. It's the 50% Fibonacci retracement level, and it coincides with this channel support right here, this red line. So if it hits 3,100, that'd be around a 7% sell-off from the highs. And again, this stuff isn't set in stone. This isn't going to exactly happen. It might, but it's more to give you an idea of what the probabilities and possibilities are. It's not a prediction per se. Now, another reason why Alex doesn't think the lows are in is because we still need to hit oversold levels in the market first. So if you look at this chart, which is the percentage of stocks trading above their 20-day moving averages, it's still above this line right here, which is the 20% level that usually marks a bottom in the market. And you see things usually turn around when it hits that green level. So we still haven't hit that yet, meaning there's more room to go lower first. Another thing Alex is looking at is the put to call ratio, which is still coming off extreme bullish readings. I'm sorry, this red line is actually the call to put ratio. Put to call is the opposite. So basically, if this red line is too high, it's showing that people are buying a bunch of calls thinking the market is going to go way higher. And it's a sentiment thing, right? You don't want a bunch of bulls, you want a bunch of bears. More bears means more money on the sidelines to come in and push the market higher. So to see this reset, we usually want to see the 3-day moving average hit a 2 standard deviation low, and that'll show you that people, aren't as bullish anymore. Now there's more puts in the market, and that still hasn't happened. So Alex says his bias this week is for a trading range followed by further downside later in the week and next week. Semiconductors and the major stock indices are short-term oversold, which is why we're seeing a nice bounce here. But of course, there's a chance that the market just rips to new highs. Earnings have been coming in much better than expected, especially for the big tech names like Apple, Amazon, and Microsoft. And since these guys make up so much of the S&P, it's possible that their bullish earnings outweigh everything and the market just pushes to new highs. And he says here the important thing is that the primary trend is up. So there's no need to catch every down move. If you're a long-term investor, you're more considered with the broader trend, which is what we're trying to go over here. And personally, in my trading, the more I focus on these shorter time frames, the more money I lose. Most of my money is made just from the long term. So you don't want to get caught up in all these fluctuations. Now, speaking of earnings, we can go over that a little bit. And the big thing about earnings that Alex has been talking about in the past is that there were really low expectations in Q4. And that's like analyst predictions, right? So when the expectations are really low, it's easy to surpass them. It's a low hurdle. So you can see this chart right here of what the expected growth was really negative. And what it's actually coming in at is this orange bar, which is less negative. And there you go. If you exceed expectations like that, then the prices are going to go higher. So in one way, you can actually benefit from analysts thinking that your company is going to do terrible. Set those expectations real low and then be an overachiever. It's how the stock market works. That's how relationships work. It's great. There's also a big shift happening right now where companies are actually becoming bullish on their own prospects. So you can see in the earnings report, this chart shows mentions of better, stronger versus worse or weaker in earnings calls. So you can see we were in a pretty bad downtrend since 17, but now all of a sudden we have this big spike. Management of these companies are getting more and more positive, and they're excited on the outlook for the economy and their company. That's a good sign. So Alex says here, absent any world-destroying pandemic from like the coronavirus, we're seeing the beginnings of the global growth rebound that I've been writing about for the last 6 months. So you can look at the economic surprise index of leading indicators right here from Bloomberg. It shows that leading global indicators are starting to surprise to the upside. As this market, once again, like the previous chart you saw, it's breaking this long-term downtrend, starting to trend higher again. Global growth is looking good. ISM in January expanded for the first time in 6 months. And there you have it. The stock market is doing well. Earnings are coming in better than expected. Global growth is picking up again. Is this the type of stuff that will finally convert the bears? Personally, I hope not, because the more bears we have, the longer this bull market will go. But if you are participating in the equity markets for this bull market, make sure you got our checklist with you, because it's going to help you find those stocks that are going to really benefit from this type of bullishness. Again, it's free, gives you 10 factors that you should look for. There's a link down below in the description and comments. Put in your email and I will send it to you all free. And if you haven't already, make sure you subscribe to this channel and hit that notification bell for email notifications when new videos come out. We're doing market analysis like this all the time. So subscribe so you don't miss the next one. And also like this video, comment down below on your thoughts on the market. I respond to like every comment. I will talk to you in the next video. Stay fallible out there. Bye.